So now in the earlier video, I talked about the heads of income. But to classify your income into the heads of income, it first needs to be chargeable to tax. So what income is chargeable to tax is a fundamental aspect that we need to look at. And that is really defined by the charging provisions of section 4 and 5. And they are very, very important and crucial to understand before proceeding forward. Now, section 4 talks about the charge of income tax. As you can see, the Central Act enacts the income tax shall be charged for any assessment year, and you go on, you can see in respect of the total income of the previous year of every person. Now there are a couple of concepts to clarify here. An assessment year is the year after the financial year in question. So for example, financial year 2021 would be April 2020, 1st April 2020 to 31st March 2021, and financial year 2021 will correspond to assessment year 21-22. And assessment year 21-22 is what the usual terminology will be. They'll say it has the assessment finished for assessment year 21-22, which means it relates to the period of time for financial year 2021. It's also called the previous year 2021, being the previous year to the assessment year. So this is a common terminology that's used, and given the income in a financial year or a previous year as it is called, the total income is the one that is chargeable to tax. And what is that total income? So the scope of the total income is defined in another section. This is very common in the Income Tax Act, where you jump from section to section for the definitions. So let's look at the scope of the total income in section 5. Now section 5 is an incredibly important section because the concepts here will ring through the act as we go section by section and idea by idea. Now the section 5 essentially talks about the scope of total income with respect to a resident and a non-resident. Now the notion of residency is incredibly important when it comes to Income Tax Act. The Indian Income Tax Act really does not care where you are born, what your nationality is, what passport you hold, etc. It has a certain set of conditions to be prescribed for you to be prescribed as a resident as per the Indian Income Tax Act. And the basic condition, we'll look at it more, it comes in section 6 in a separate video. But the basic condition clearly is that you have to stay a certain set of days. If you do stay in India for a certain set of days or more, then you become a resident as per the Indian Income Tax Act. And there are other conditions also, and there are a lot of minutiae and details, but for now this concept is enough. So assume that you do stay for a while in India and you hence become a resident of as per the Indian Income Tax Act. It used to be very simple, 180 days. There are some complications now which we'll go into. So now let's take that you are a resident as per the Indian Income Tax Act, then the global income of a resident is taxable in India. This is very, very, very important. The global income of a resident of the Indian Income Tax Act is taxable. Now if you are a non-resident, it's not the global income which is taxable, but the income which is laid down in 5.2, which is received or deemed to be received, or accrued or arises, or deemed to accrue or arise. These amounts are taxable in India, even if you are a non-resident. And the logic is pretty simple. Suppose you are a non-resident, you are sitting in the US, let's say, and earning money. No doubt from an employer there. No doubt that income is not part of the Indian Income Tax Act. The Indian government doesn't want that money and tax that money, nor does it have a claim for that money. But assume that you have a rental property in India and you earn rental income in India. Then definitely the Indian Income Tax Act has, and the Indian government has some power over you to charge tax on the amounts that you earn in India. So the question then becomes, when you are a non-resident, to figure out what is the scope of total income which is chargeable to Indian income tax under 5.2A and B. And we will look at 5.2A and B in detail now. But before that, let me just wrap up the resident. So with the resident, it is very straightforward, right? Any income which you earn globally is subject to tax in India. And your immediate question would be, what if I also earn money outside India, will it be subject to tax? Yes, it is subject to tax in India. But if you do pay tax on it in some foreign country, then you get what is called a tax credit here. And we'll go into this notion of tax credits and various other provisions later on in videos. Now let's talk about 5.2 for a second. 5.2 talks about what is the total income chargeable to tax for a non-resident under the Indian Income Tax Act. Now you'll be wondering, why is a non-resident even taxable under the Act? But logically speaking, suppose the non-resident has properties here which earn rent, or has fixed deposits in Indian banks which earn rent. Surely the Indian government has a hold over the taxation pie and has a right to tax. And so it's important that what income of the non-resident is related to India is defined so that it will be brought under the Indian Income Tax Act provisions. And that definition comes under 52AB. Now, if the non-resident has income in the US, which he, for example, is an employee of a US company sitting in the US and rendering those services, clearly that does not come under the Indian Income Tax Act, nor does the Indian government have the jurisdiction nor the necessity to tax that income. Now, so what relates to India is well defined in 52A, received or deemed to receive, 52B, accrues or arises or deemed to accrue or arise. That kind of income of the non-resident, if it satisfies these criteria of received or deemed to be received in India, accrues or arises or deemed to accrue or arise in India, such income shall be taxable in India of that non-resident. So the non-resident's income now becomes taxed in India, and he is no longer excluded from the taxation of the Indian regime. Now the key thing is received or deemed to be received and accrues or arises is a bit intuitive. But the notion of deemed to accrue or arise is actually very wide-ranging and very controversial. And that is a matter of section 9, which we will look at next. Now before I go to section 9, so I hope everybody understands section 5 in its entirety. So you have these two items. One is a resident and the other is a non-resident. A resident's global income is taxable. A non-resident's, it's not the global income which is taxable in India, but a non-resident's income which accrues or arises, deemed to accrue or arise, received or deemed to be received in India becomes taxable. So you have to figure out what the non-resident's income is chargeable to tax in India, and that's a huge matter of litigation always. And then with respect to residents, it's very straightforward. Now before I go on to section 9, one more point. What happens if a particular part of income is taxable in both countries? For example, a resident I said was taxable in his global income. What if that income was earned in the US and subject to US tax law? So therein lies the whole concept of a foreign tax credit. If you have paid tax in one territory, you can claim credit for those taxes paid in other territory for that same income, which is going to be taxed there. So we'll get into all the foreign tax credit and all those details later in much more detail in videos. But let's now, having talked about 5 and the scope of total income, let's now get into the deeming fiction that 52B introduces, which is section 9. So section 9 talks about the income deemed to accrue or arise in India. And if you're a tax practitioner, you could spend away your entire life pretty much in the various minutiae under section 9, especially 9.1. 9.1 talks about the following incomes which shall be deemed to accrue or arise in India. And 9.1 is the holy grail of a thing called business profits taxation. And let's just read 9.1 along with its explanation and see what this is. Again, it's important to understand the concept, and we'll probably devote a lot of videos to 9 over a period of time. But let's just get the ideas first. 9.1. All income accruing or arising, whether directly or indirectly, through or from any business connection in India, or through or from any property in India, or through or from any asset or source of income in India, or through the transfer of a capital asset situated in India, is considered income deemed to be accrued or arising in India. Now, if you look at it prima facie, this notion of a business connection is very wide. Business connection can just be a transaction between the resident and a non-resident. And so there's a famous case called R.D. Agarwal, which I linked to in the description, which talks about the wideness of business connection. And so if that is the case, it's a bit shocking, isn't it, that every transaction of the non-resident then can come under Indian Income Tax Act, because all income accruing or arising, whether directly or indirectly, through or from any business connection, seems a very widely worded section. And the check there is in the explanation. Now let's look at explanation 1A. In the case of business, other than business having business connection in India on account of significant economic presence, of which all the operations are not carried out in India, the income of the business deemed under this clause to accrue or arise in India shall be only such part of the income as is reasonably attributable to the operations carried out in India. Now, this is a very important check. Now, what it means essentially is that only that part of the income of the non-resident which is attributable to his or her, that is the non-resident's operations in India, if any, will be considered as income taxable in India. So in other words, it means that only the operations carried out by the non-resident in India, where say for example it can be an office, it can be a branch, it can be any kind of establishment here, the income which is reasonably attributable to those this operations that is carried out by the non-resident in India will be only the income taxable of that non-resident in India. So this notion of operations carried out in India is essentially what is called a permanent establishment. A permanent establishment of a non-resident is well defined in Article 5 of the double taxation avoidance agreements between India and other countries, and is also defined in the Act. We'll look into it. But the fact of the matter is, this concept of a permanent establishment and only operations carried out by attributable to that permanent establishment are to be taxable. The income arising out of which is to be taxable in India of the non-resident. So in effect, it restricts the income of business profits really of the non-resident to that of the income attributable to his or her operations in India. And so it's not the wide scope of all the business profits of a foreign business will be taxable in India. And so this is a logical extension, and this has been the cornerstone of business profit taxation for a long time. If you look at the double taxation avoidance agreements, the DTAs entered into by India and other countries, which we will go into in much more detail in other videos, you will see pari materia Article 7 and Article 5. Article 7 is similar to 911 and Article 5 talks about permanent establishment, and here 911 explanation 1A talks about operations carried out in India. So it's pretty much pari materia, and it's important to realize that this is a logical understanding of how things are in terms of taxability. So there have been changes, and we'll discuss a lot of these changes, which are interestingly brought about, for example, due to digital economy, due to virtual economy and things like that. And so no longer can you have a operation in India well defined, isn't it? You could be anywhere in the world and be serving to Indian customers. So those kind of points are the reasons why there were amendments made in 91A, explanation 1A, and so those kind of amendments will have a significant impact of the taxation in the future. But as far as we are concerned, conceptually, a non-resident's business profits will be taxed in his or her country only, unless they have a permanent establishment in India to which that income is attributable, and in which case then the Indian government comes in and says, I have a right to taxation. A classic example of 911 is this issue of foreign agent commission. Now I'll dedicate a separate video to it, but let's understand it conceptually first. 911 basically says, let's assume there's a foreign commission agent sitting in Italy, and the commission agent, this is very common in the export business, right? You employ foreign commission agents to get you orders, to procure you orders in those lands. So for example, an Italian commission agent will be a company in Italy which is registered in Italy, taxable in Italy, and they will be a sales agent for your product. Suppose you are exporting fashion textiles from here. So they will canvas for you and get you new orders of Italian customers, European customers, etc. and take a commission on the sales, 5% commission, 10% commission. And this is very common and it's been going on for ages. The textile industry depends on these kind of commission agents. Now, the payments made by the Indian assessees or payers to the foreign agent payees, is that amount taxable in India? Now, this is clearly the income of a non-resident commission agent. Now, the income of a non-resident commission agent, as you know, is going to come under 5(2)(b), and you have to see whether there is received or deemed to receive. It's not the case. Is it accrued or arisal in India? Well, the notion of accrual or arisal in India, it is not the business activity of the non-resident in India which caused those orders to come. It's in fact the business activity of the non-resident in Europe or Italy which causes the business orders to come. So it would not mean that. And then what about deemed to accrue or arise? And there you go to 911. And 911 says So there is a income accruing arising whether directly or indirectly through business connection. So the business connection is the Indian client paying the foreign commission agent. So the foreign commission agent's income will be brought under tax in India unless you look at explanation 1A, which clearly says only the income reasonably attributable to the operations carried out in India. Given that the foreign commission agent does not have operations in India, we are assuming that he does not have an office here or anything, and he sits as a this Italian case, for example, he's an Italian agent who is registered in Italy. He has no business operations in India. So the commission agent payments made by an Indian textile company to sell their goods in Italy to an Italian commission agent is not taxable in India under 911 read with explanation 1A. And if you look at the DTA, it would be that Article 7 read with Article 5 would end up with the same logic. Now this was part of huge amount of litigation because of some issues with CBDT circulars which are withdrawn and things like that, which we'll go into. But logically speaking, I hope you understand that 911 read with explanation 1A is very crucial to understand the business profits, whether the business profits of a non-resident is taxable in India or not. Now the other interesting things in 9.1, and we will go over the other 9.1.2, 9.1.3, etc. But the key litigative aspects and the key department thrusts are 9.1.6 and 9.1.7. And I'll finish the video by talking about 9.1.6 and 9.1.7 and relating it to 9.1.1. As I said, the importance is to understand concepts. And if you understand this key difference between 9.1.1 and 9.1.6 and 9.1.7, which we are going to go into, I think you'll pretty much understand the idea of section 9 itself. Now 9.1.6 says if it's income by way of royalty, right, by a person who is in India who is paid to a non-resident, right, then in such cases that income is deemed to accrue or arise in India. So let's take an example here. So the first part is there is a payer in India, probably a company who uses say designs or licenses from say some engineering firm in the UK, let's take for example. Now the payment for the use of his IP or intellectual property goes from India to the non-resident. We are talking about the non-resident case here, right? The non-resident UK firm or company, and the non-resident UK company, that income in the normal course they will say it's my business profits, it's only taxable in UK. 9.1.1 is there, explanation 1A clears I don't have a permanent establishment or operations in India, so the entire thing is taxable only in the UK, not in India. Please don't disturb me, right? And that's what they'll say to the Indian government. But then there's 9.1.6 which says if the income is by way of a royalty, then it is deemed to accrue or arise in India. So income by way of royalty, the department will say this is not normal business profits, but this is royalty income. So don't tell me that this is just business income of yours. This is classified as royalty income. And how do you classify it as royalty income? So the purpose of classification of royalty is in explanation 2. Explanation 2 of 9.1.6 gives a wide-ranging definition of royalty, which has been incredibly litigated upon. Every comma, every word in that explanation 2 pretty much has seen litigation. And it's subject matter of a lot of amendments and a lot of controversial issues related to those amendments. But it suffices to us to understand that the department will try to say that this income which has accrued to the non-resident by way of say payment from India for some IP is not business income of the non-resident, but rather is in the classification of royalty income. And so the royalty income does not have any concept of necessity of a PE or permanent or attribution to operations in India. See, that's the key difference. So the key difference is for 9.1.6, if it is a royalty income paid to a non-resident, the issue of attributing some the income to operations in India only, carving out that income only to be taxable, doesn't arise, right? And it's similar to 9.1.7, which also says there's another kind of income for fees for technical services. It can either be royalty income or the non-resident can earn a thing called for technical services. So royalty typically has been considered as IP, designs, licenses, things like that, right? You can think of royalty as a like for patents, intellectual property in terms of copyrights, etc., which you are using. So you have some IP which you license from a foreign let's say automotive giant, and then you use it for your vehicles here and you pay royalty, that's clearly royalty income. Technical services are much broader and are general technical services. In fact, the explanation of technical services defines it as any consideration for the rendering of any managerial, technical or consultancy services. So this is very broad, and according to me it's pretty unbelievable definition in terms of its ambit. Managerial, technical or consultancy, pretty much every service can come under FTS. And so this broad swath of definition, of course the courts have kind of reined it in, saying there must be a human expertise for this, and we'll look into those in separate videos. But so if an income is classifiable as either a technical service income or a royalty income under 917 or 916 as the case may be, there is no need for a permanent establishment or any operations of the non-resident in India for it to become taxable in India. It's a deeming fiction, a fiction that a payment for technical services or payment for royalty to a non-resident, he may be abroad, he may do all the services abroad, it may be everything can be abroad, but it is still taxable in India. This key point has to be understood. The deeming fiction that you're bringing in the non-resident taxation into Indian territorial regime of the Indian Income Tax Act, just because it is of the nature of royalty or fees for technical services, is a very important concept. Now, this is always not simple. It has been heavily litigated, and I can't stress upon how heavily it has been litigated and continues to be litigated. And there's so many interesting points and interesting cases around it. But let me give you an example why this was so heavily litigated. In fact, what happened is the 916 and 917 they were originally litigated. There was a case called Ishika Wajima Harima, which I will include in the description. And the Supreme Court said, surprisingly so, that even for 917, in the case of even for income by way of fees for technical services, the services should be both rendered and utilized in India for it to be brought under this deeming fiction. With due respect, I don't think that's a correct interpretation of a deeming fiction, but if you see, most cases the rendering of the service would be abroad, right? Let's take an engineering, drawing, design consultancy service. I pay money from, I am an Indian company, I pay money to the UK engineering design company, they give me some drawings. Now, the UK company did all the drawings in the UK, right? And so the rendering is always typically done in the foreign country, and the utilization is by me, so clearly utilization is in India. So, but the Ishikawajima Harima Supreme Court judgment peculiarly said, if the rendering and utilization twin conditions should be in India for 917 to apply. And this gave a lot of leeway to the SSC to say that, look, rendering was outside, utilization is inside, and hence there is no question of technical service being charged. Now all that is settled now. In the and there were missteps in settling it, but in Finance Act 2010, finally the government introduced an amendment which introduced an explanation which actually says, explanation for the removal of doubts, it is hereby declared that for the purposes of this section, income of non-resident shall be deemed to occur and arise under 5, 6, 7 subsection 1 can be included in the total income whether or not the non-resident has a residence or place of business or business connection in India, or the non-resident has rendered services in India. So we come back to our original point that as long as the department is able to classify the income paid to the non-resident as a royalty or fees for technical services, wherever it is rendered or utilized, it doesn't matter. As long as that income is classified under that head, then there is a right of taxation under the Indian income tax. And so there is this tension always, and this concept is what I want you to understand. There is this tension that the assessees will say the income is nothing but, they said the non-resident assessees will say their income is nothing but the business profits which come under 911 and are not taxable in India because there is no permanent establishment under explanation 1A. The department will say no, it's not actually business profits, it's not business income. This is actually fees for technical, the income in the nature of technical services because you rendered technical service, or is the income in the nature of royalty and is under 917 or 916 and clearly comes into taxation of the Indian government. So this tension is what is the heart of a lot of litigation on Section 9. And we'll go into all of this and in much more detail. I hope this gave you a good idea of the notion of deemed accrual arising in India. So to step back, Section 4 talked about total income, Section 5 talked about total income with respect to the resident and non-resident had this notion of a deeming fiction, and the deeming fiction is defined in Section 9, and Section 9.1 talked about business income which can be brought into the Indian income tax only on operations carried out in India. 916 and 917 talk about royalty and FTS, which have a much wider scope in terms of wherever the services are rendered or utilized. If it is in the income is in nature of royalty or FTS, they can be brought to tax in India. So this is a general view I hope will help you to understand section 5 and 9 in broad detail. Thank you.